Hey everyone, I'm Ben, the VP of Engineering here at BTCS. I'm an engineer. I'm not a public speaker, so I apologize if I rush too fast on here or I'm not too clear. So thank you guys for listening and tuning in. What I'm talking about today is actually not engineering, it's accounting. Accounting is one of the hardest things to solve in public companies going into DeFi. So we're talking about bridging the GAAP. GAAP stands for Generally Accepted Accounting Principles. Making digital asset treasuries, making their activity legible under US GAAP. A little background on BTCS, we are an Ethereum DApp, almost by second nature. We run a couple thousand validators across Rocket Pool and Solo nodes. We're also a block builder on Ethereum as well as BTC. And we have a pretty large treasury right now of Ethereum that we deploy actively into DeFi operations. So this is the challenge that public companies have in the crypto space. Crypto's moved faster every day; it's moving faster, and accounting standards are set decades ago. And so public companies have to apply outdated standards to fast-moving composable systems. And these public companies are now deploying ETH, Bitcoin, Solana, and stablecoins and other assets into DeFi. The accounting rules haven't caught up, especially for wrap tokens and DeFi yield. These are all foreign concepts to auditors, foreign concepts to the SEC and the FASB. So digital asset treasuries, they need audit-ready clarity. One of the reasons I'm even talking about this today, I didn't really want to talk about BTCS. I wanted to talk to the teams that are selling to public companies. These are the type of services that public companies need if they're going to use your DeFi products. So DAS must make DeFi activity auditable and explainable, and we have to explain this to auditors that are outdated, they're old, they don't understand how Etherscan works, they don't understand how any of these products work. And accounting outcomes depend on how the assets are structured and how yield is generated, and also how you can explain that to someone who has no idea what crypto is. Getting it wrong means misstated assets, inconsistent revenue reporting, and confusion for investors. And misstated assets or inconsistent revenue reporting leads to missing your 10Q filings. Missing your 10Q filings means you lose S3 eligibility. So this is just like a high-level example here. This is how public companies are viewing any DeFi activity. DeFi starts with sending assets to a smart contract and receiving a wrapped version. These wrapped versions come in either rebase tokens or non-rebasing receipt tokens of these things. This is pretty high level. But there's really two key factors that public companies need to look at when reporting these assets. The first one is it a fair value asset? Can you mark it up and down? Or is it impairment only? Now, impairment only is very bad. Most public companies want to stay away from that. It's very misleading to investors. And so when we're talking about this, we're looking at ASC 35060. This is one of the guidance, sort of guidance that's been given to us by FASB, that if you are selling to public companies, you need to know ASC 35060 in and out. Because of ASC 35060, most crypto assets can now use fair value accounting, which means like as the value goes up, so can your balance sheet. But a lot of wrapped tokens still fail to qualify and must use impairment accounting, which means they're written down to the lowest value ever with no markups. And that makes financial statements wildly out of sync with economic reality. And in the next slide, we're actually going to see that in terms of Sharplink's Q2 filing. So very quickly, fair value accounting, it's mark to market. As the price goes up, so does your balance sheet. It looks great. It reflects the current fair value on a balance sheet, not just the lowest point when it's held, and you recognize the gains and losses immediately. With impairment accounting, you can only write it down once you buy an asset. If it falls below the purchase price, that's now how much that asset is valued on your balance sheet as a public company. It's locked in there until you sell it. The only time you can record profit is at a point of sale. You only record the losses. So if you look at Sharplink stock ticker SPET, their 10Q from Q2, they purchased about $750 million worth of LSTs at an average price of $2,800. Obviously today, ETH is above $2,800, even just a few weeks after they purchased it. Although it had dipped, it had actually gone up to about $4,000. And at the time of reporting, they had to report an $87 million loss that we can see on the right side right here, the economic reality of at the filing time, the value of those assets had actually gone up $250 million. But as we see on the 10Q, they're showing an $87 million impairment on those assets. And this is just very confusing to investors, especially retail investors who aren't going to be reading into this stuff. And the second most important thing here is, can we translate the DeFi yields into revenue, or are they specifically only other income? So DeFi yields aren't traditional interest or service fees in the mindset of auditing teams and SEC filings. It's all brand new concepts for these people. Like we watch these institutions talk about like, how can a stable coin give yield? They just don't understand these DeFi products that are coming out today. So for yield to count as operating revenue, you have to look at ASC 606. So we talked earlier, ASC 350/60 and ASC 606 is the two most important themes when trying to sell a public company. You need to understand these things. There must be an identifiable performance obligation, like providing liquidity or validation services, meaning that you're a principal actor in the space. You're providing some sort of service. There's actually a risk component as well. And the company must be the acting principal. Otherwise, the yield is classified as under income. And it's not bad to have other income, but revenue is one of the core metrics that are kind of the traditional fundamentals. And so really what these companies have to do is they have to bridge between the engineering and the finance. So engineers have to understand the record keeping and audit needs. I never figured I'd have to go read ASC 350/60, and it was a pain in the ass to read it. So was 606, and to actually understand what those meant. And now my CFO never expected he had to know what Fartcoin was. So obviously these two teams need to come together so they can have audit-ready DeFi. And that's really what the BTCS model is for these things. Some of the teams here, we've actually spoken to you guys about different DeFi products. And these are what our most important things are. We want to focus on fair value eligible assets. We don't want to have any impairments. We want daily on-chain tracking and valuation controls. It needs to be transparent to the point that all these auditors can see it as well. And we want to classify yield streams up front. And we have to design for auditability, not just profitability. There may be a great opportunity to arbitrage between two meme coins, but if it's not clear, it's not accountable, then we're not going to touch it. And so ultimately, if you're trying to sell to digital asset treasuries, you have to follow these things. You understand how your token mechanics fit under GAAP. That's ASC 350/60, ASC 606. And then consider your wrappers and yield products that minimize accounting complexity. Make it simple, one single token if possible. Obfuscate the yield somewhere else and bring it into a single wrap token. And then simplify reporting with transparent traceable data. It has to be on-chain. Having your own L2 for these things adds a lot of complexity. Position your product as accounting-friendly infrastructure, not just a DeFi yield flow. It's great to get double-digit APY, but if we can't account for it, we can't use it. And then public companies will confidently participate in DeFi by adopting audit-friendly practices. And ultimately, public company adoption depends on innovation that accountants can respond. So, thank you.